Welcome back to ACCA Wiz. In this video, we're covering Chapter 7, Pricing from the Performance Management paper. Let's break it down into simple concepts with examples so you can master this chapter for your exams. Learning objectives. By the end of this session, you'll be able to understand what affects pricing decisions, work with price elasticity of demand, use demand and cost equations, find the optimum selling price using marginal revenue equals marginal cost, decide when to expand sales, and apply different pricing strategies like cost plus, penetration, and skimming. We'll also solve worked examples along the way. Introduction to pricing. Pricing is at the heart of profit. Remember, profit equals selling price less cost. The price you set doesn't just recover costs. It directly affects demand and sales volume. Market structures. Different markets give businesses different levels of power to set prices. In perfect competition, firms are price takers. In a monopoly, one seller can set prices freely. In an oligopoly, a few firms dominate, so each one carefully watches the others. And in monopolistic competition, products are differentiated, so companies have some control over pricing. Price elasticity of demand. Price elasticity of demand tells us how sensitive customers are to price changes. If price elasticity of demand is greater than 1, demand is elastic. Customers react strongly to price changes. If price elasticity of demand is less than 1, demand is inelastic. Customers are less responsive. Businesses use this to decide whether to raise or lower prices for revenue maximization. Price elasticity of demand curve. Here's the demand curve. Notice the elastic region at higher prices. Small price cuts create big demand increases. In the inelastic region at lower prices, price cuts don't add much demand. Price elasticity of demand example. For example, if the price drops from $10 to $9, demand rises from 100 units to 120. Price elasticity of demand equals percentage change in quantity, that is 20%, divided by percentage change in price, that is minus 10% equals minus 2. This means demand is elastic, so lowering the price increases revenue. Straight line demand equation. We can also model demand using an equation. Price equals A, B times quantity. Here, A is the maximum price when demand is 0, and B is how much price drops per extra unit sold. This makes demand predictable. Total cost function. Total cost equals fixed costs plus variable costs. If discounts apply, the function becomes stepped. For example, up to 5,000 units. Total cost equals 250,000 plus 6x. Above 5,000 units. Total cost equals 250,000 plus 5.4x. So cost change as volume grows. Optimum price and quantity. Profit is maximized where marginal revenue equals marginal cost. Before this point, producing more adds profit. After this point, producing more reduces profit. Marginal revenue and marginal cost chart. So here, the orange line shows marginal revenue and the blue line shows marginal cost. The intersection point is the optimum. The output is 20 units, where marginal revenue equals marginal cost at $20. But remember, the selling price is not taken from marginal revenue or marginal cost. It comes from the demand curve. At 20 units, the demand curve tells us customers are willing to pay $60 per unit. That's why the optimum combination is quantity equals 20 units, price equals $60, with marginal revenue and marginal cost balanced at $20. Optimum price example. Let's solve it. Demand equation. Price equals 100 less 2 times quantity. Total revenue equals 100 times quantity less 2 times quantity squared. Marginal revenue equals 100 less 4 times quantity. If marginal cost equals 20, then setting marginal revenue equal to marginal cost gives quantity equals 20, price equals 60. So the optimum is 20 units at $60 each. Increasing sales. When considering expansion, check incremental revenues and costs. Accept if extra contribution is greater than extra costs. Reject if extra fixed costs outweigh the contribution. Approaches to pricing. There are 3 main approaches. Cost-based pricing. Add a profit margin to costs. Demand-based pricing. Set price based on customer willingness to pay. Competition-based pricing. Match or position against rivals. Pricing strategies. Some common strategies include cost plus, simple, ensures cost recovery. Skimming, start high, then lower over time. Penetration. Start low to gain market share. Complementary. Price main product low but charge for extras. Product line. Different price levels across a product range. Volume discounting. Lower price for bulk. Price discrimination. Different prices for different groups. Relevant cost pricing. For special orders, based on incremental costs. Strategy comparison. Here's a comparison. Cost plus works well in stable markets. Skimming is for unique new products. Penetration works in competitive markets. Complementary suits link products like printers and cartridges. Cost plus example. If cost per unit is $50 and we want a 25% margin, price equals 50 times 1.25 equals $62.50. Relevant cost example. For a one-off order of 1,000 units, variable cost equals $15. Offer price equals $20. Contribution equals $5 per unit, $5,000 total. Since it adds contribution, accept the order. Chapter summary. To sum up, pricing decisions shape profitability. Market structure determines how much control firms have. Elasticity and demand equations help set prices wisely. The optimum price is always where marginal revenue equals marginal cost. And the right strategy depends on market context and objectives. That's Chapter 7, Pricing. If you found this helpful, don't forget to like, share, and subscribe to ACCA Whiz for more exam-focused content.